Hey everyone, welcome back to Investment Physics. Disclaimer, I'm not a certified financial advisor. I'm just giving you my own thoughts and opinions, whatever things I have learned based on my curiosity. Please do your due diligence before investing. So last time I posted a video about analyzing Rivian stock and whether it is a buy. So one of my friends saw the entire video. There was a lot of fundamental analysis, options chain analysis, DCF, etc. So he saw the video. It was also based on a book called The Intelligent Investor by Benjamin Graham. So he saw the video and he said that, yeah, I followed all these principles. And then I thought, if this is a way to fundamentally analyze the intrinsic value of a company, I thought Nvidia currently seems very overvalued by these metrics. So what if I just short Nvidia and make money? But then I became poor in the process of doing this. So then I thought, okay, maybe let's make a video on analyzing Nvidia and whether it is a good time to short it. Before I go into the crux of it, let me explain what is shorting. So the most common investing method in the stock market is called as going long. Long is when you buy a particular stock and then you hope that the price goes up over some years or days or whatever. And when the price goes up, you sell and you collect the difference as a profit. But then you can also do the opposite, which is called as a short. A short is basically you sell the stock first. You sell something that you do not own and you hope that the price goes down, and when the price goes down you buy it back, and whatever difference, that is your profit. Shorting is not supported by all brokers. In the US there are some brokers like E-Trade and Ameritrade that allow it, but of course shorting is a more riskier process than going long, because when you go long you just pay money upfront to buy a stock based on that day's market value of the stock, and then when it goes up or down there's nothing else you have to pay extra. But when you short, it's not like that, because let's say you short a stock at $10 today, and tomorrow if it becomes $12, these brokers will issue something called as a margin call. A margin call is basically the broker asking you to deposit more money into the account because they expect that the stock can go more up, but you have not given that much money upfront. So when this margin call happens, you should have enough cash ready to pay to the account to maintain your short position. If not, they will basically sell your short position at a loss and then close the trade. What exactly is the margin call amount, or what percentage they ask you to pay, depends on the broker. They do a risk calculation analysis based on your stock portfolio value and what exactly you have shorted and how volatile that instrument is and things like that. They use some model of their own, and then they compute how much money you have to deposit extra when the stock goes up. So from this explanation itself, you would have figured out that shorting is not as straightforward as just buying a stock and forgetting about it. It's more complex both for you and for the broker, and you may often need to deposit extra cash to maintain your short position. You can also do short in the options market. They do it by something called as buying puts. You can either buy naked put or put spread. I'm not going into the details of it, but there are methods to do it in the option market too. But anything with the options, your prediction has to come right within a given time. So let's say that you hope the stock to go down and you buy some put or something, but the stock goes down after 2 years and not within like 1 month or something, then you may still end up losing money even though your prediction is right. So that's why even in options market you have to think about these kind of scenarios before you decide to short a stock. Let me give you some examples of what has happened in the past and what would have happened if you had shorted those stocks. So there is this company called as Victoria's Secret. I'm not going to explain what Victoria's Secret does or what its business is. I'm going to assume that you already know. If you don't know, just go Google and have some fun with it. Okay, but Victoria's Secret had declared bankruptcy in August 2021. On that month, the average stock price was $74.77. Victoria's Secret's current stock price is $19.32. So a company that has declared bankruptcy over 2 years ago, it has still not completely died, and his stock price is still not zero. It is still trading at $19. This is just to give you an idea of how long a company can take to die. Even after they declare bankruptcy, even after people know that it is an unhealthy company without much fundamentals or anything like that. And this fall from 2021 to 2023, it was not like a straight line down from 74 to 19. There were like ups and downs in the middle. So if you had shorted somewhere in the middle and the stock price went up, there was a high chance that you got a margin call and you have to deposit more money to the broker, and still hope that the price goes down. And if you were to take a short position today, I'm still not sure how long this company will take to fully die, because as of today, they still have 808 stores which are still active in the US. And the company has still not given a clear timeline on when it plans to shut down all its stores. So yes, it could take quite a while for a company to die. Let me give you another example. It is of course Apple. So today we all know that Apple is a huge company. They make wonderful products like MacBooks and iPhones and all that. But in 1997, they were on the verge of bankruptcy. They did not officially file for bankruptcy, but they were almost close to it. And then Microsoft, which was its arch rival back in the time, they gave $150 million to bail out Apple, and that's how it survived and became the huge behemoth that it is today. So even though a company is on the verge of extinction, there could be these kind of things that could happen and rescue the company, and the stock price could completely take a turn. So imagine if you were there in 97 and you shorted it based on fundamentals, and then Microsoft rescued it after your bet. It's very likely that you lost your money. So this is just to give you some history of the pitfalls of shorting a stock. Let's go into the details of Nvidia, the metrics of what it is today, and let's think of what can be done to trade Nvidia based on today's information. So Nvidia's current PE ratio is 238. PE stands for price to earnings. It's basically a ratio where the numerator is the current price and the denominator E stands for the earnings per share. The PE is for the last 12 months. Basically, whatever the company has earned during the last 12 months, they divide it based on the number of outstanding shares to compute this PE ratio. Its historical PE ratio is definitely very low, and even the forward PE, which means that based on the future growth value, the analysts estimate that the forward PE is 60. So 238 and 60 is definitely a very large contrast. And you might think that the company is definitely overvalued and you can just go ahead and short it without thinking much. Let's also look at some other numbers. So I did a quick options chain analysis, and the options, the people are betting that Nvidia will be priced between $400 to $500 on August 18. Why August 18? Because the next earnings results for Nvidia will be on August 23rd. Usually earnings can change the game. They could either the CEO can either give statements which basically gives a very positive or negative guidance, and based on that the bets in the option chain markets will change. So we can only consider what is the current bet before the earnings day, and people expect it to be 400 to 500. So people are not expecting that to fall it by too much, because today I think the price is $425. So they're not expecting a large fall till the next earnings basically. The DCF analysis, DCF is discounted cash flow valuation. I will do a separate video on what exactly that is. But the DCF for Nvidia, it estimates the intrinsic value to be 81.64. Of course, today's stock price is well above 400. And based on the DCF intrinsic value, the stock is overvalued by 82%. Analyzing the graph, the RSI is in a overbought category, but the other numbers or the other trend lines, like the moving average of 50-day, 100-day, 200-day, etc., they all show a very clear uptrend, and they are not even showing any sign of reversal yet. So it all shows that even though the numbers say that Nvidia is currently overvalued, there is nobody else predicting a very big fall right now. Partly because the earnings are just around the corner, so they just want to see what is going to happen in the earnings. So let us see what exactly has brought the limelight to Nvidia in the recent days. So Nvidia, it's basically a chip manufacturing company. They make both CPU and GPU type of chips. Nvidia is very popular among the gaming community. They have a lot of GPU, graphic processing units, which are used in a lot of good gaming consoles. Nvidia shot into the limelight during the crypto phase because they had some custom chips which could be used for Bitcoin mining rigs. And during that time also a similar hype blew it past into expectations. Right now the AI hype with ChatGPT and Bard and everything else, Nvidia has a product which is used for this AI training and processing, and that is what has brought Nvidia to the limelight again. Nvidia's current popular AI training chip is called as H100. It has a powerful tensor core, and it is again a CPU plus GPU combination type of a chip. But this is the product that is propelling it into the limelight. In the last earnings, Jensen Huang, who is the CEO of Nvidia, gave a very positive guidance. And he said that they are expecting very huge growth numbers, and a lot of people, especially data centers, they are trying to buy this chip and whatever AI training chips they may produce in the future, so that people are able to produce more AI related use cases and software. Um, of course, Nvidia is not the only player in this game. There are a lot of other chip manufacturers too who want a piece of this pie. So AMD has already made a product called as M1300X. It is again like a AI training model chip. And then Intel also has a product called as Habana Gaudi 2. And then Intel has a product called as Habana Gaudi 2. So currently Nvidia has the highest benchmark rating for AI training data. The other products, they are not as good as Nvidia, in essence is what I'm trying to say. But clearly they are not going to sit quiet. They are going to try to improve upon the products, and in the future the market share of Nvidia AI chips may be divided among all three. We are of course yet to see how much of actual sales revenue will be there and how much the AI hype will result into actual earnings for these three companies. But yeah, we have to keep monitoring the future earning calls of all of these companies and how the whole AI game plays out. All I'm trying to say is there are other companies making similar chips. So because Nvidia is nowhere like a dying company and it is a very healthy company with positive earnings outlook, it is not exactly a wise decision to directly short it. But we can place some convoluted short bets. Let me give you an example. So there is this company called as TSMC, Taiwan Semiconductor Manufacturing Company. It is actually a very small company in Taiwan. Currently, all these chips by Apple, AMD, Nvidia, Intel, all of them are designed in the US. But they don't manufacture the chip themselves. They don't have their own foundry or all of that is needed to make a chip. They outsource the manufacturing to this company called as TSMC. TSMC has been doing this for a long time. Their most recent specialization is in what is called as the 7 nanometer chip. And then Apple M1 chips are manufactured by TSMC. The Nvidia's H100, their AI chip is manufactured by TSMC. AMD's AI chip M1300X is manufactured by TSMC. Intel's Habana Gaudi 2, it is not yet clear who will manufacture, but that company is also considering outsourcing the manufacturing to TSMC. So it seems like there are all these companies building their own AI chips, but under the hood, the actual manufacturing is just done by TSMC more or less. So if you really want to play the AI bet, it would probably be better to buy TSMC instead of shorting Nvidia. Because TSMC, I'm not going into a complete analysis of TSMC, but I did some basic analysis and it looks a bit undervalued. Warren Buffett has also bought some TSMC shares in the past. Just to give you an idea that there is some interest in this company even from big investors. So if you were to buy TSMC, you are more likely to make money because they manufacture AI chips for all of these companies, and if even one of them clicks, this company's stock price will go up, and eventually you will make a profit. So this is one method to do a convoluted bet. The second is Intel. So Intel has been an undervalued company for a very long time, mostly because they have completely missed the mobile revolution. Intel specializes still on making CPU for laptops and servers, but these days most of the sales are happening in mobile, and Intel does not have a very power efficient mobile processor chip. But if they play this AI card right, and if they are able to bring a successful AI chip to the market, then obviously the price of Intel can soar compared to these other AI chip manufacturing companies. So it might be better to either buy TSMC or Intel instead of shorting Nvidia to play this AI race card as things stand today. Of course, please do your own analysis. This is just from what primitive analysis that I have done for myself. Um, I would like to end with this quote by John Maynard Keynes. He's a popular economist. Markets can stay irrational longer than you can stay solvent. So even though a company seems very overvalued today, if you short it, you may not have enough money to maintain your short position till the stock price falls down. So it is, don't use the fundamental principles or Benjamin Graham's book or anything like that to decide which stock to short. Please consider only to decide which stock to buy or which stock not to buy if the fundamentals doesn't look right. But don't go into the shorting game is what I would suggest. Hope this helps. Thank you. If you like my video, please consider liking and sharing. If you really love my video, please consider subscribing and also pressing the bell button icon so that you will be notified as and when I make a new video. Thank you.